I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
Good morning. Good morning, and thank you for coming to our conference this morning entitled Market Meltdown, New York's Financial Crisis. I'm Howard Husick, Vice President of the Manhattan Institute. As the national and world economies struggle to cope with the current financial crisis, New York faces its own especially daunting challenges. We are buffeted not only by the immediate effects of a credit crunch, but by the long-term consequences of recent events on our most important local industry, financial services. How did things go wrong, and are current public policies likely to put things right? What will the effects, both fiscal and political, be on city and state government? Finally, can New Yorkers reinvent our economy yet again? These broadly are the questions which our distinguished speakers this morning will consider. We at the Manhattan Institute are privileged to convene this discussion at a critical moment in New York City's history. To start things off, I turn to the moderator of the first of our three panels, the former publisher and current columnist of the Wall Street Journal, Gordon Crovitz.
Good morning, everyone. There are a lot of ways to describe the current unpleasantness. The conference organizers have called it the market meltdown. I think it could also be called the panic of 2008, and it could also be called the biggest intervention by government in markets in the lifetime of almost everyone in this room. We're very fortunate to have with us two great panelists who can address the opening question of how we got here. In the process, we might also learn some things about how to get out of where we are, and in the process, hopefully, cause the least amount of damage. Amity Shlaes is a senior fellow in economic history at the Council on Foreign Relations. Bloomberg carries her syndicated column. You'll recognize her byline from the Financial Times and from the Wall Street Journal. Amity has written two national bestsellers, The Greedy Hand about taxation and The Forgotten Man. National Review called The Forgotten Man the finest history of the Great Depression ever written. There are more than 130,000 copies in print, and given the market meltdown, it's back on the New York Times bestseller list. David Malpass is president of Encima Global. My Spanish is a little bit rusty, but I think that means on top of the world, David, which is where we always want you to be. This is an economic research and consulting firm. He's a former chief economist of Bear Stearns. He also served in the Treasury Department and the State Department from 1984 to 1993 in a variety of roles, but including while at Treasury and working on the S&L bailout. I'm going to ask each of our panelists to speak on the topic. We'll then have a discussion among us, but we want to be sure to reserve time for your questions, which we will do, so please keep them in mind. Amity, I'd ask you to start. Thank you.
Good morning. Oh, there we go. Okay. I want to first read to you a headline from October 22. Stocks slump again. From today, but today in 1929. And I wanted also to read you the first paragraph of this story because it sounds so much like the moralizing newspapers we have today. Amid scenes of wild confusion and drastically lower prices, the stock market continued to pay the piper for its long dance of advancing and inflated prices. Organized support for pivotal stocks did not develop. So where we are in terms of history is before the Black Days, Black Tuesday, Black Thursday. At the end of October, we're about to celebrate those anniversaries. What I'm going to talk to you very briefly about this morning with this mini PowerPoint is not the crash of 29, but what followed, because 29 crash did not have to be followed by a decade plus of depression, just as our crash does not have to be. there were 5 sins that were committed by policymakers subsequent to the crash that made the Depression great in magnitude. The first one is familiar to us, getting the monetary wrong. Hoover and Roosevelt got it backwards. They saw inflation where there was deflation. You may recall that Hoover got it wrong, but FDR also got it wrong during his campaign, so that would be analogous to now. FDR accused Hoover of conducting an inflationary orgy. At a time when the country was so out of money, towns made their own, and I got one piece of the money for you. Sometimes they even made money out of wood. Getting the taxes wrong, that's very important to us here in New York because we already had them wrong before the crash. Mellon was a Reaganite figure from the 20s. He cut taxes 5 times. The top rate was 25%. By the time he was done, they even went down to 24 for a tiny bit. In despair, Hoover wrote the Treasury, which included a sorrowing, departing Mellon on his way to be ambassador to Britain, into pushing the top rate way up in the name of budgetary problems caused by the crash. Remember, this is a period, you want to think about the 30s, what a change to go from 25 to 63 and higher. We knew all that, but you want to be sure and know the details of the Hoover tax as we think now. 5% sales tax on autos, most important consumer product. Tax on checks was part of the Hoover 1932 tax plan. A tax on telegrams, a tax on... Talk about sand in the gears. In a delicate time, you're in a downturn, your economy's collapsing, you add a tax. That's what they did. FDR did raise taxes again up to 90. I think the rate is only part of the story, and you want to know that. Enforcement can be negative because it's scary. Of course, the New Dealers spoke a lot about class warfare, princes of property. You've heard that phrase. That was one of FDR's favorites. He spoke of wealthy people by name. He liked to make lists of names of people who were wealthy. He saw, and his treasury under Morgenthau, who was a goofball, his treasury under Morgenthau saw no difference between a tax deduction and tax evasion, or they willfully chose not to see it, and they read their names aloud on the radio as well at some points in the Depression. What was the effect? Chill. Go to your country house, don't invest, hide. All those New Yorker cartoons that we saw of the period are true. Wealth went on strike. There was a capital strike. Blaming the messenger. They too, of course, in the New Deal and Hoover before, went after short sellers. Why did Hoover hate short sellers? Because temperament always has to do with what happens in crisis. Because he was a mining engineer, he had made his wealth out of the ground. He was a creature of the gold standard era. He was suspicious of markets. He was suspicious of bank stocks, for sure. He reminds me a little bit of Paul O'Neill at the Treasury a few years ago. That's a little bit mean of me to say that, but that is, he had too much of a real orientation. He didn't see the growth where there was growth. He saw always only bubble. And they went after the business heroes. Greenspan was Mellon, that figure I spoke of before. Mellon was higher than Greenspan, actually. It was said of Mellon that 3 presidents served under him. In those days, the Fed was weaker. We had a different Fed law. So there was this one figure in the firmament. Another was... I don't know where it is, but there's somebody missing in here. The second one was Sam Insull. They went after him as well. Insull was roughly analogous to Bill Gates or Mr. Brin. He electrified Chicago. He did a lot of the theoretical work behind the modern grid concept, and they went after both of them. Tariff, threw on a tariff, that's a sin. Oh, sorry, these slides are out of order. They kept Mellon in court. What happened with Mellon? They kept Mellon in court until he died. So you want to imagine a decade of keeping your Greenspan in court. Insull, they put him behind bars too. What that did, it scared them. Let's go back and look at Insull again. Both these men were in court until they died, more or less. Insull lost his entire fortune. When Mellon died in August 1937 in Southampton on Gin Lane at his daughter Ailsa's house, the market crashed. Why did it crash? Because 8 years in, the last star from the old firmament was winking out. Imagine if Greenspan would die 2 years hence. Same thing. People thought, oh, we will never go back to a markets-oriented America. Roosevelt had a slogan that we learned about in school, bold, persistent experimentation, supposed to be all upside. Sounds nice. Somebody had to do something. That's what we learned in a monetary freeze, and you hear it being evoked today, that phrase. Markets did decide to wait it out. Companies didn't hire or invest. There is such a thing as a recession of uncertainty, what the scholar Robert Higgs calls regime uncertainty. When you see the scope of what the government is going to do is so broad that you freeze. When you have domestic unknown unknowns as well as foreign policy unknown unknowns. So they waited and they waited. Final sin. I wanted to stick this one in, using crisis as your pretext for a reform agenda. FDR used unemployment as the pretext for writing the Wagner Act. That killed jobs. There's some wonderful new scholarship by Lee Ohanian at UCLA that blames labor policy for those famous unemployment levels of the 1930s, infamous, I should say. Results were unambiguous. Volatility, we're talking a lot about that today. One thing about the 1930s, we've all heard about the downs. Look at the ups. The red isn't that clear, but up 70% in 1933. What you see, there was many famous ups in that decade as downs. You also had the same one-day volatility events that we are seeing now. That's because no one knew what the government would do. Unemployment doesn't really get below 10 no matter how you count it. 2 in 10 out of work as late as 1938. That's 9 years in. We don't remember it. That's part of the problem. Our legacy is pro-intervention, and you see our politicians today framing it all in terms of the advantages of activity, experimentation, and intervention. And I just put this picture at the end. Thank you so much. I want to add one last thing, because this is a New York day. New York was the loser in this period. Just as now there was a power struggle between the financial capital of the United States and the political capital, and just as now New York lost. And I would argue it didn't recover until the 50s. Thank you so much.
Hello, everybody. I'm sorry I got stuck underground and couldn't call. It's very nice to see you. Thank you, Gordon, for having me. And it's a deep pleasure to be on the same panel with Amity Shlaes, who's been a friend for a long time. I'm going to overlap right at the beginning with Amity and then move on. I want to talk about the differences from the Depression that we're in right now, some of the similarities, and then talk about where we're going from here. So like the Depression, there was a similar response in the population and in Washington in terms of deep concern in financial markets. Government mistakes, I think, and Amity outlined those. We've seen, I'm going to go through some of the regulatory policy mistakes that have been done in this particular instance of crisis. There's also the same thread of criticism of the private sector. I have an article in the new Forbes coming out today or tomorrow, which is about the bulge of power in Washington and how successful they're being at directing the blame toward the private sector, similar to the Depression. And then it's bad for New York, as Amity mentioned. So some similarities there. Also in terms of the private sector, leading into this, lots of capitalism and greed within the private sector, and not too much warning from the private sector to Washington that things were as out of whack as they were. were margin loans being called day by day this time as they were in the Depression. So there are some similarities. But to me, there are more differences. The differences are, and Amity alluded to, the monetary stimulus this time is completely different from what was done in the Depression, and I think will be more successful. So the Fed is putting gigantic amounts of money. One of the things happening is the Fed's balance sheet is expanding. It's already doubled and looks like it may double again, meaning the assets and the liabilities have moved from a $900 billion level already to a $1.8 trillion, and it looks to me like they'll move toward $3 trillion in terms of assets and liabilities at the Fed. Also different is the reservoirs of liquidity. In the Depression, people ran out of money. This time around, there are huge amounts of money around the world ready to come back in and rebuild growth once the crisis settles. That's, I think, a critical difference. Also, banks aren't failing, so the Fed and Treasury have fully guaranteed many parts of banks' liability side and also the asset side. Even yesterday, the Fed was busily guaranteeing or making available funds for commercial paper, so you have this gigantic federal guarantee spreading out over the financial system, and that, I think, works very well. If we recall back, Venezuela in 1992 had a run on banks, and the country was bankrupt, and the government guaranteed bank deposits, and people left their money in banks. And it's because people actually trust that kind of a government guarantee and don't cause runs on banks when the government guarantees them. Also different is that trade is not crashing the way it was in the Great Depression. So how did we get here? I want to put a lot of emphasis on the monetary policy mistake in 2003, 4, and 5. So the Fed set interest rates at 1% out of thin air. Could it have been 2%, 3%, 4%? Yes. And would those have been better? Yes. We would have had as good a growth for the economy and not as much going into housing. So the Fed really pushed the interest rate level down, encouraging leverage. So then the household sector levered up in response to the government policy. Amity has talked about, in her book, FDR, setting precisely the gold price. Well, the equivalent in this crisis is the Federal Reserve setting precisely the interest rate level, which is not something that is necessarily the right way to do monetary policy. It's just the way we do things. And in 2003, it was simply the wrong level of interest rates, and that distorted the whole economy. The Fed was thinking in 2003 that we were in a deflationary environment, when clearly we were in a reflationary environment. The dollar was weakening, gold prices were rising, and by 2005 we had nearly 5% inflation, even though the Fed was still doing small interest rate hikes, thinking that there were deflationary tinges to the economy. Second it follows from that. From low interest rates, we got a weak dollar, which is causing a lot of the problems that we're seeing today. Third is third is the poor regulation that was going on throughout this crisis, and I'll just list the various spots. The rating agencies, the bond rating agencies were putting AAA ratings and charging fees to bond issuers for a AAA rating. So it's like you going to your teacher at school and saying, I'd like an A+, and the teacher says, okay, that'll be $20, and you get your A+, and so pretty soon all the students have an A+. The CDS market that has grown, I'm not actually a critic of the concept of the CDS market, except that's credit default swap, so it's insurance on bonds, but it was unregulated and it's opaque. There's no knowledge of what's going on, and I think that should have been sorted out much earlier. There was little regulation of mortgage brokers, little regulation of Fannie and Freddie. What regulation there was pushed them in the wrong directions to making more and more risky mortgages. And it was an aggressive push for 10 years onto Fannie and Freddie to make more and more risky mortgages with implicit government guarantees behind them. So plenty of blame to go around, including of New York, the investment banks that partook of this liquidity. I used to use the story in 2003, 4, and 5 when it was the Greenspan free lunch. You had a giant punch bowl of liquidity that the Fed had overflowing. The punch was running onto the floor, and the investment banks had big goblets, and they were all they were close in on the punch bowl and would dip into the punch and then take a big gulp and pass it back to the people behind. So that was going on for some years, causing the problems. And then as we got into the crisis, meaning at the beginning of this year, still Treasury wouldn't do the things that would have helped. The mark-to-market problem, the dollar weakened, remember, right through July. So why are we in this today? Because oil went to 145 in July on the back of a collapsing dollar right through July. So I think that's the roots of the problem. And then finally, Treasury at that time, as companies began to fail, insisted on the idea that equity holders be wiped out. So they created this somewhat artificial fight between bondholders getting that the world was run by bondholders at the expense of equity holders. And so what that meant was no new capital, certainly none from abroad. The weakening dollar kept it away from the U.S., but none from even domestic investors would go into banks because you'd seen the pattern that equity holders repeatedly were wiped out. So you had a catch-22 where Treasury basically said you must raise capital, and yet equity holders were systematically being wiped out. That has changed. So where do we go from here? I think after the Lehman bankruptcy, the AIG bankruptcy, and then especially the Morgan Stanley crisis of 2 weeks ago, week and a half ago, Treasury has changed. They want equities to go up, and they've started injecting capital, bank capital, into equities from the Treasury facility. So there was a full about-face in terms of government policy in September that I think will work to stabilize the system amid all of this, the Fed doing more and more guarantee facilities. So what I want to emphasize the powerful tools that the government is now deploying and doing a better job of deploying them. We will have a sharp recession. We're in a sharp recession now. It's global, but it seems to me that the tools are in place to begin a recovery in 2009. What we will end up with is bigger Washington, much bigger regulatory, more jobs, more houses, more responsibility for the economy, and that should be a concern for everyone to think about. Can they do it? Do they have a good track record in doing it? Things like that. We'll end up, I think, with higher tax rates, which is bad for New York, clearly, and also, I think, bad for the longer-term growth outlook. And so my final then issue is for each of you to think about, as we see the market this morning again going down and talk of the depression still with us. The most comforting thing I can think of in this, apart from the United States is a small business economy and has lots of innovation and creativity, which is true, is the question in 2003 through 2006. Trillions of extra dollars were created. And so you have to have an opinion of how much of that was wasted. If you think most of that was wasted, then we're in deep trouble because you've created all that money and blown it. And that's what happened in the 70s. As the inflation set in, the Fed created more and more money, and it went to sovereign loans to Latin America. Remember that? So the carry trade in the 70s was the Middle East would deposit money in U.S. banks who would lend it to Argentina. As the world went into a recession, the money evaporated. This time around, the carry trade was the Japanese homemaker lending money to the Philippines, which tried to build ports, buildings, facilities. There was a huge carry trade into Asia in general, a carry trade into even into Brazil this time that wasn't wasted. Brazil is not doing dollar borrowing, it's borrowing in local currency. So as you think about your own situation or how worried do you want to be about the world, I think a starting point for that is how really off track do you think things were in 03 to 06? So there were trillions of extra dollars created. Do you think half of that was wasted? My own view is 20% of that was wasted, but we're left with 80% of it that can be used to rebuild and cause a recovery in 2009. Thanks.
Thank you both very much. I thought I'd start the questions by adding a little bit more historical perspective, but a little bit more recently, which is that I think all of us recall different people, whether economists or journalists or others, warning that there was a problem, a powder keg in a way set to explode, led by Fannie Mae, Freddie Mac, led by, in some cases, by regulation, in some cases, David, as you say, by a punch bowl caused by liquidity. Why was it that those warnings were not heeded? What is it about our politics or our markets that allowed the situation to occur, and as you say, David, for Washington to be so surprised by what happened in markets?
Yeah, so historians will try to sort this out and figure it out. I guess one thought I have is the profits were so big in the short term that they covered up people's concerns. So if the rating agency will give you a AAA and you're an investment bank that provides leverage or helps companies get leverage, and your fee is going to come in within a year, it's very hard to say, look, this isn't a sustainable process. Also, we had the huge stamp of approval from Washington saying everything is okay. So recall Chairman Greenspan's very strong support for the idea of the interest rates are okay, inflation is going to come down, don't worry about it.
I think, is this on? Yeah, can you? I think one reason is demographic. If you graduated college later than 82, you'd never really experienced anything bad, and those people were now 25 years in, and just didn't have that visceral memory of a rough period, hadn't tried to buy houses in the early 80s. They were too young, and those people came to be the executive class just by virtue of their age and were therefore too optimistic. A second factor that's important with Fannie and Freddie is that this is a failure by the media. It was an asymmetrical reward system when it came to writing about Fannie and Freddie. There was a ton of downside and very little upside because Fannie and Freddie were complex, hard to explain, and when people in the financial press went to write about them, they did really come down hard and bully institutions for covering them or trying to. Paul Gigot, the Wall Street Journal, has spoken about that. It happened to all of us. And it certainly happened on a much larger scale to congressmen, and so people addressed Fannie and Freddie episodically. They would raise the question, do their duty, and then move on to another topic rather than systematically. And that holds all the way up, by the way, to Chairman Greenspan, who did warn but was unable to find the energy to push for reform.
Gordon, may I add to this? I think we can look back and say in many ways each individual actor was acting rationally in their own interest, meaning if you didn't have any assets and the mortgage broker came to you and said, you can buy this house for no down payment and you'll move in next month, what's your answer? So your answer is yes. And now the consequences are coming out, but you were living in the house for some time and you had the chance of a big payday, meaning if things had worked out, you would have made quite a bit of money. So I think we had asymmetrical risk-return kinds of things. And I think I could apply that to the government too. If you're a congressman and someone says, why are we taking all this money from Fannie Mae and Freddie Mac and not regulating them? It looks like it's going to blow up. The answer is, well, there's an election in November, and it's a full rational response to the circumstances presented. Now, for myself, I didn't see how bad it would get now, and I will admit to over-optimism including early this year. I really thought the Bush administration would stop the dollar from its plunge. They had several opportunities earlier this year as the money was just flying away from the U.S. Remember, gold went up to $1,000, indicating an absolute panic away from the dollar, and yet at no point did the administration stand up for that. That surprised me. I think the mark-to-market problem was laid out very clearly in late 2007, and there was no administration response to it. The mortgage rates have been high throughout, so people keep throwing money at the problem, but won't talk the mortgage rates down, which is an important part of the housing stabilization. So you have quite a few things. If you'd sat in 2007 and said we're entering a crisis, I would have thought that the administration would address some of those things earlier. Even take up through 2 weeks ago, the preferred stock, the idea of injecting the Treasury money into preferred stock has been around for a decade and has been actively promoted to the administration for a long time, and yet it was only a week and a half ago that it came to the conclusion that it should inject capital.
We now see the federal government, Treasury, Fed, other agencies, much more involved, obviously, in the financial markets than for decades. I wonder, Amity, perspective of what errors were made in the Depression, many of which you touched on, as you see the policies that are now being pursued or tried or the experimentation that's going on, what are the biggest risks of the government reaction so far? And that's really a question for both you and for David.
What I found looking at the 30s was there was an untold story. When we grew up learning about the 30s, we learned that the federal government as a player was good in the Keynesian sense. It was injecting liquidity. It was stimulating the economy, all the verbs we hear now. But as I mentioned before, there's also a power struggle between the public sector and the private sector, and the public sector can crowd out the private sector, even though the medicine can come from the government, but the cure, the recovery, is on the back of the private sector, almost always. The struggle in the 30s happened in 3 or 4 arenas. One was over control of the money, literally monetary. FDR took control of the money, and as David mentioned now, we're taking control of the money through our Fed law, whether we want it, or through our mediocre Fed law that we have that gives the Fed this discretion to set interest rates with very little solid criteria. 2, they had to fight over money through taxation. They captured the money, the capital, from the private sector through their prohibitive taxation. They also had a third fight, which I think you want to look for now too. FDR saw that there was an industry where growth inhered. Where did growth inhere in those days? What was their iPod, their Mac? It was utilities. So he had a power struggle with the power industry, and he deployed considerable resources into fighting this one industry, utilities, power. And that was where all the fun and growth was in America, and he took it away through institutions that we know and sometimes love, such as the Tennessee Valley Authority. And that caused there to be nothing left over, no capital. So we always want to pay, and finally, another way is the capital fight of the capitals, the financial capital, as David writes in his column, and the political capital. So all those struggles, you want to be aware what's happening there when you look now. What's happening? Who's winning this? Because it really is two guys on a mat or two kindergartners in a sandbox fighting, public and private. The school of economic thought that seems to me most useful here is not classical economics nor Keynesianism, but rather public choice theory, which says government is no better nor worse than the private sector. They're just two guys on a mat duking it out, and you want to say, where are we in that, and who benefits from this?
That's great. So I think in terms of following right on from there, checks and balances, which agencies don't have them and which do. So in the case of Treasury, they have expanded their power massively in the last few weeks in terms of this facility, but it is governed by the debt ceiling. Remember that they had to raise the debt ceiling in the legislation, so there's some congressional check and balance on that in the future. They've used a 1934 law to guarantee money market funds. Now that's authority that they never used up until now. It was secret authority. So you would want to scour the books and see what other kinds of superpowers does the Treasury have hiding there. And specifically, do you want it to continue guaranteeing money market funds? So there's some practical things there. A concern is on the Fed itself. The Fed is not subject to appropriations or to the debt ceiling. And so as it expands its balance sheet today, and yesterday, what it announced it was doing was allocating $560 billion. This is money by anyone's standards to buy commercial paper directly from issuers in some way. That will go on their asset side, and they'll fund it with deposits from banks that they can now pay interest on. And there's no check or balance or limit. They can do that with, and they are doing that with investments in bank debt, in different types of bank debt. And so at some point, there has to be a thought process about how big do you want the Fed to be, and how do you want, is there any type of check and balance that you want? My preference, of course, would be for the role of the Fed to scale back to the original role, which is price stability and a lender of last resort in a crisis. But we are light years beyond that today, and so a question is, how do you get back to the original role? With regard to banks, there'll be huge regulation, and people have to have an opinion of what should a bank be? Should it be like a utility where you sign up for electricity and they don't ask who you are or how you got there? They want to see that you can pay and cut you off if you don't pay. That in many ways the government is investing into banks and will gradually move them in that direction the way it did with Fannie Mae and Freddie Mac, meaning you are they were institutions designed and built to make mortgages, not to ask questions about the mortgages, just make the mortgages. So to some extent there's a transformation going on in banks that way. And finally, I'll mention housing. Underlying this is the government role, meaning the Washington role, in how many people should have houses, how much risk do we want to take in their ownership of houses. And the U.S., unlike many other countries in the world, has gone whole hog into the idea that everyone should own a home no matter their job or their creditworthiness. So is there any way to roll that back? It looks to me like that will be entrenched, that everyone has a right to a house, and so we've got to think, okay, we understand that, but there must be some limits somewhere, and that's what we'll explore over the next 3 years.
So we'll move to questions in just a moment, but I wanted to ask one final one for this part of our session, which is that markets are, by their nature, understand the need to mark themselves to market, to have a level of transparency, to acknowledge mistakes when mistakes are made. That's not always true, I think, of our politics in Washington. But in that spirit, David, you touched on the mistakes that were made by our financial institutions. You mentioned the credit derivatives as a particular example of an instrument that maybe turned out to be too much of a good thing. Could you comment a little bit on what went wrong in the private sector, in our financial institutions run by some of the smartest people in the city who made enormous mistakes?
Okay, the CDS market, credit default swaps, is insurance on bonds. So if IBM issues a bond, you can buy an insurance policy. It's a concept that is relatively new, so it emerged in the 1990s. And then once it came about, people decided, boy, this is a great idea. I own some bonds, and I'd like to insure them. And the people selling the insurance looked at the environment in 2003, 4, and 5. It was a 1% interest rate environment. The punch bowl was overflowing, and said, shoot, I'll sell you that insurance for practically nothing. And so the volumes in this market went very large because the price of the insurance, it was being underpriced. It'd be like if I offer you life insurance, $1 million of life insurance for $100, and I won't check your health, you should buy it. And then you say, you don't know who I am, but that's okay, it's $100. And so that was going on rampantly. And this is a little dangerous. If you can buy insurance on somebody that you don't have an economic interest in, that means that there's some inherent distortion that's available. If I can buy insurance on a luminary and then bid up the price of that insurance, so I keep bidding and bidding, and that person looks more and more risky because the price of the insurance is going up, that becomes a distortion within the market. And so it's hard to know exactly where this all went wrong. One is there should have been transparency in terms of who bought insurance from whom, and that should have been recorded so that people knew. That was not done. I think also then the interplay with the bond rating agencies is important, that the rating agencies were saying AAA, and they were looking at the price of insurance and saying, golly, they're selling insurance at practically nothing. It must be a safe bond. So that interplay became dangerous. So then, as things went wrong in 2007, the price of the insurance went up. The bond rating agencies had come to depend on that as some justification for their rating, so they began downrating without maybe any very much independent judgment. And so we're left where we are today with a giant mess. Now, the good news on this is people cite this huge number, CDS. The CDS exposure is $64 trillion, or sometimes you hear $80 trillion. Nobody can even count. It's like I wrote insurance on you and sold it to you for $100, and then I didn't keep any records on how many I wrote. So I wrote insurance on everybody in the room and threw away the paperwork. And you bring the paper to me and say, you insured me, I'm dead. And I say, I'm not sure I did. So the good news here is the Lehman settlement last night occurred. So we had the first accounting for this. And it turns out that a lot of the insurance was netted. And so we ended up with, and I don't know these numbers, and there's some in the room I notice who are true experts on this, but maybe there was $1 trillion of notional, and they ended up with $6 billion of net exposure. Maybe there are stories this morning on it, but that just means that $64 trillion may actually underneath it have $500 billion of at risk. It's not the end of the world. So the problems that it caused, we are paying for now with misallocation of capital and misestimate of bond ratings, severe misestimates. But as far as where we go with it, I don't view it as a giant risk for where the world is headed.
About 2 or 3 years ago, one of the cleverest people actually invoked Roosevelt, and he said the only thing we had to fear in 2006 or 2005 was the lack of fear itself, and that turned out to be true in that period.
That's
Thank
right.
you. Why don't we open it up to questions from the audience? Sir? There's a microphone on its way.
Thank you. I think Amity's point that whatever the government does, I think you said that the recovery is on the back of the private sector. Absolutely true. So how do we dig ourselves out? And the second question is, are the policies of the presumptive next president, Mr. Obama, are they going to be in a position to do this?
Well, I was going over the McCain tax plan this morning because I'm going to write a column about it, and it's a nice tax plan. It's a good tax plan. It makes us want to grow so that we don't have that monetary overhang that David was describing before. It eats away the inflation by generating productivity through corporate tax cuts, through basically accelerated depreciation, the ability to expense stuff first year, not just computers, sustaining the Bush tax cuts, and so on. The question is it a priority even for McCain? And in McCain's mind, and with the Congress that he gets, if he wins, which he probably won't, will they do it? On the Obama side, I don't think they've thought it through yet. They have a very redistributionist plan, and he is doing a Latin-style rhetoric right now, although that may be an insult to Latin America to say that, but it's quite populist. He's failing to acknowledge that the way progressivity works, Obama is, so he's saying something's unfair when, as we know, higher earners pay a greater share. He's acting as if he's working in a flat rate and talking about fairness. So the rhetoric is deeply disappointing from someone as intelligent as Obama. I am interested to see the one that Paul Volcker has been advising Obama, and you've seen that Volcker has been talking about a serious recession, just as David has been talking about. So I don't have quite the dark view of the Obama administration, but the combo of that plus trifecta, Democratic House and Senate, is not pro-growth. And I'll just stop there and say that.
First, we have to stabilize the financial system. Now, I think they're accomplishing that. Now, people can still argue about that. So, by guaranteeing everything, you actually do create some sense of stability. So then, in 2009, the issue is how to allow that to turn back into growth. Now, the new president will have will have better circumstances than people are thinking. Everyone says, oh, I wouldn't want to be president in 2009, but everyone really should, because in 2009 you'll start with a very low equity market. You'll start in a deep recession. That's a better situation than having one after you've joined in. You have the dollar coming back from a panic sell-off, and so that gives you wind at your back, meaning the money is coming back to the U.S. that had been pushed away for all those years, and there's huge amounts. We're talking trillions of dollars that was pushed away from the U.S. that will come back in now and in 2009 and 2010. And so whether that can offset our bad tax policy, whatever Obama does, we should recognize it's this giant tax code that's got so many inefficiencies in it that even if you had good intentions, it would be hard to fix. Remember, the situation that we're left at the end of the Bush administration is that the Bush cuts are scheduled to expire in 2010. We've never had a situation where it's an automatic giant tax increase 2 years hence. And we don't know how, the normal way private sector should respond to that is by not investing. So that's going to be a challenge in 2009 and 2010 for whoever's president. What I've wanted is for McCain to be talking more about strengthening the dollar and making the tax cuts permanent as a scoring issue. I don't want to get into it, Gordon, but Washington is very fouled up in scoring tax cuts in that they don't take account of the consequences on the economy or on financial markets. Remember, if you put in a big tax increase, let's say in Washington, and you submit it to the Joint Tax Committee and ask them to score it, they'll say the growth rate, GDP is unchanged by this, and you look at them and say, wait a minute, anybody can see this is going to slow down growth. No, not in Washington. And second, the equity market will tank. Let's say you propose that dividends go back to ordinary income. Everyone knows that equities are going to go down by 15%, except in Washington, they really don't take account of that. So we have this broken scoring system in Washington that no one is talking about planning to fix. Bush had many chances to address it and didn't. So that just means that I think we ought to assume a bad tax situation in the coming years, but a better situation on the dollar, and those tend to balance off.
So maybe the silver lining is now that Washington is in charge of Wall Street, the scoring system may be improved. Yes, sir.
Let's focus on entitlements, Social Security and Medicare, Medicaid. The 2017 date when the cash flow technically goes negative is somewhat irrelevant in my mind because the Social Security surplus has been part of ordinary spending, budgetary spending, and that is diminishing as we speak. So Social Security crisis is here now in the sense that the cash flow is getting less. There'll be less tax money coming in to spend. Medicare and Medicaid is, 7 times as large a problem, and that's here now. An Obama administration is going to have to face these, the financial fact of the entitlements now being here. It's kind of ironic that they're both Social Security and Medicare are Democratic programs, Roosevelt and Johnson. What do you think of the timing and the magnitude of these two on top of everything else that we're talking about this morning?
Couple comments, and Amity's an expert on these, so I'll defer. So the fiscal deficit is going to go up a lot. However, the estimates that people use, remember, are coming from actuaries whose job it is not to be too optimistic, meaning, I didn't say that right, to be as pessimistic as possible. So when you hear about those long run, 50 years from now, it's going to be a $70 trillion shortfall, those are completely made up numbers. So you really have to discount those. If the economy grows, then it can afford the Social Security commitments that have been made. It can't afford the Medicare commitments. So if we want to kind of simplify this down over the next 8 years of an Obama administration, it will have to deal with rising fiscal deficits. But if the economy grows, it's not going to create an action-forcing crisis for Washington. And we see that in the 10-year T-bill. So if you invest money in the U.S. government today for 10 years, you lock it in, no call, no way out, they're only going to pay you 3.7% per year for 10 years. So that's showing you the market estimate of this problem. So I think as we think about it, it's this, that the Medicare commitments to the elderly are unsustainable, and they're going to be degraded over the next 20 years, meaning less effective doctors, and so we'll move to some system of private insurance on the side. It's an ugly prospect.
I think we had a question. I'm sorry.
Oh, I just wanted to add, in terms of employment, that payroll tax cap is going to blow.
Oh.
So that's 6% your employee side plus the employer, which is all by itself a huge marginal rate increase. The Obama plan is a kind of donut that is currently the cap is at about 100,000. People just above 100,000 will have the cap. They won't pay that Social Security on their last dollar of income. But then when it gets to New York levels of income, 200, 300, he lifts the cap, and every dollar earned is subject to that 6% plus the employer side, which will deal a massive blow to the whole employment situation, whether we can afford to do it. And you want to add that in to the end of the Bush tax cuts, plus whatever tax increases we have in New York that our colleagues will describe later this morning. So this will make employment and working so much more expensive, just the Social Security all by itself.